Life learners, V here from V Life Journal, back with week 4 of Venture Vlog with Chatty. So, a bit of personal update. Sometimes life threw us a curveball, and I had some minor health treatments that required me to take a few days off for recovery, and hence not much progress was made this week. It's a good reminder that no matter how passionate we are about our projects or career, it's crucial to listen to our bodies and know when to take a break. So now on to exciting news. I had a great conversation with David, our previous guest, who is a co-founder and investor of a real estate private equity fund, which is exactly our target market for the ESG Financial Impact Estimator prototype. I'm eager to share with you some profound insights again from this discussion. It was fascinating to hear his perspective and what I need to do with our prototype. So the remaining part of today's video will feature highlights from this conversation. Trust me, you will not want to miss this, as it has significantly informed the direction we are taking with our ESG Financial Impact Estimator. So before we dive in, don't forget to like, share, and subscribe for more updates. And please send me your thoughts. Your input will shape this journey. See you all next week. And now, let's hear from David.
If we talk about ESG, there's 3 components to it, right? The easiest or what most people would think is the E part of it, environmental. Just because social and governance, it's more abstract. And environmental, it's easy, right? The easiest example, you mentioned it yourself. It's how you can renovate a building or build in a way that saves in utilities or save in energy. The thing is, utilities usually is tenants who pay. So developers might not care as much. What they might care, well, for development purpose, they can see ways to build more green, or maybe they can sell at a higher price. That's not my expertise because I buy existing buildings. And usually existing buildings obviously have older technologies, if you can say that, or are not built in today's code. They were built in 1990s codes or 1980s codes, so on. So there are things that you can change, like LED lights, roof maintenance, those kind of things that could save you in the long run, especially someone who buys a building. You can I'll change a roof with the cheapest material just because it's for rentals, for tenants only. But as a responsible landlord, if you're holding the property for long term, you want to put better products, better materials, because in the long run, you get what you pay for, right? Instead of lasting every 10, 15 years, the roof, it will last 25, 30 years. And it's not double the cost. It's maybe 30, 40% more expensive. So it is worth it for a long-term investor. In terms of insurance risk, or let's say more material stuff, as landlord, we do provide a fire extinguisher for each tenant. And if you think about it, it's only $15 or to $20 when you buy in bulk. And for bigger buildings, it's not in the unit that's inside, it's in the common areas. And this is something I think rarely landlords do, but from our hundreds of tenants that we've gone through, I know 2 tenants have used it. So probably we have avoided a fire for those 2 cases. Obviously, we have insurance, and if there was a fire, insurance is going to pay for it. So it's not like we're saving on that money, but we are saving on insurance premiums that's going to be increased. We are saving on the deductible that we would have paid of a $5,000 or $10,000 for the bigger buildings. And if you think about it, 100 times, a fire extinguisher, it's also lost rents too, because the building has to be renovated or repaired, we lose those kind of rents. These, I guess you would be able to calculate easier. If you work in the P&C insurance industry, for example, you have fire frequency and fire severity. So you know the claim cost for fire or water or whatsoever. And so you can start to see for a landlord, if you provide these to the tenant, it doesn't cost much, but it saves you a lot of headaches. It saves you the claim cost or the deductible, because the claim cost is paid by the insurance. And then you can do some sort of what's the value added. But that's numbers wise. Human wise also, but for the tenant, it's actually their home. They lose their home. They lose all the products inside, their goods inside. These are things that are less measurable, that probably it will be your challenge. So we always tell you what's easy to calculate for an actuary and what's less easy. And it's your goal kind of to find the indirect cost that's harder to calculate. But if you have a good tenant, you want the tenant to stay. You don't want them to lose their home. You don't want them to have a financial stress, because once the unit is repaired and they return or whatsoever, they still have went through a financial stress, which means perhaps higher risk of not paying rents and etc. So these are, you can say, environmental, because you prevent fire, you prevent waste, you prevent insurance damages or property damages that happens in your building. So that's the easy part, I would say. Social is part of a core strategy too, because the properties that we buy, you probably heard about landlords, or bad landlords evicting tenants. Now, the reason why they evict tenants is because they want to increase their rents once there is a turnover. And this is what's often in the newspaper and is badly seen. It's unethical and it's immoral, because you're basically kicking tenants out. And if they don't go out, you start to close the electricity, you start to close the breaker, or you cut the water and you force them out, and a very unethical. So we strongly believe in being ethical. And this is perhaps the hardest way to calculate how much value add there is. Like for us, it's just a question of, does it make sense or not? Like, how do you want to do business? Does it make, is it something that you can sleep at night? And you will be able to sleep at night if you're creating something for your future generation. Like I have kids, and is this something that I would want people to do to just like how you teach kids, right? What you do to others, others will do to you. And as an adult, we should continue in that thinking. But a lot of adults forget that thinking. It's all about, like I win means you lose, or if I lose, it means you win. But value creation is not, it's nothing about the zero-sum game. It's a non-zero sum game. So we can both win and create value. How much is that value? Well, good at calculate it. And if you have the answer, let me know. I'll use your product, your MVP. Another thing too, I think about my clients. My clients being the private equity investors who invest in the properties that we purchase. Now, they are all accredited investors because by law, they have to be accredited to invest in our private equity fund. Being accredited means they're at a certain point of their lives where they are financial savvy. That's why they have achieved this status. And myself, I am also an accredited investor. So what I do with my money, I also think, what do I want to invest in? Do I want to invest in a GP, a general partner, who is doing these shady things to kick out tenants? If he does shady things to kick out tenants, he'll probably do shady things to my money if he has the opportunity to. So there's the part of reputational risk that perhaps landlords who do evictions, those kind of things, or get in the newspaper for doing bad things or immoral things. Maybe it's working for them and they're doing it with their own money, or some of their partners that are okay with this. But from what I've seen, most people want to contribute to them. Yes, they want to pay less tax, like we all do, but we want to have a more direct contribution. And this is one way. You invest in people who have this reputation of doing good. What is the value of this? I don't know. I like it's just a feeling. And again, if I can generate 15 to 20% return or more annually for an investor, having an equitable approach, it already beats all public markets, stocks, bonds, those kind of things. I don't need to try to do shady things to get an extra 5% return to increase this to 25, 30%. And it's not sustainable too. Like, how long will this business do if I evict, flip, buy, evict, flip? Every time it has to be a new project, and one day there won't be such project because you've burned your reputation, or our regulations start to change because the government tries to protect the tenants too from these kind of landlords, these kind of bad apple landlords. But if you have an equitable approach, then you can afford to buy a building and hold it for long term. And you don't need to always think, okay, what's my next project? What's my next project? I have a good building and I can keep it because people are happy and it's well maintained. And I don't need to think about getting rid of that asset to get that quick buck. That's the social part of it. A way that's easy to calculate, one portion of it, is the financing part. So in Canada, there's CMHC, which ensure the mortgage. So they do help also for financing and refinancing on multifamily rentals. And when they have this ESG program as well, less about the G part, but environmental. If you do certain type of renovation that can save on greenhouse gases. And social is the part where you keep a percentage of your building as affordable rents. So they do give financial incentives for this, and with like, let's say, less interest rate, less fees for the CMHC, and a longer amortization period, and therefore less mortgage payment, right? So it improves the cash flow. So this is fairly easy to calculate. You just need to go down CMHC website. They explain the ESG program. It's called MLI Select, and there they show what are the different criteria and what are the incentives that they give. And we do use a lot of these programs that the government have to save or to add value financing. The MLI program from CMHC, a lot of mortgage broker knows about it, especially mortgage brokers who works in the commercial field. So creating a calculator just with this, it's more or less value add, because there's not that many mortgage broker that focus on commercial rentals, but that's just one aspect, right? And there may or may not already have a calculator related to that, but probably not in the way that you will do it, because the way you do it is more what's the value add. But for a mortgage broker, it's easy to see, okay, how much cash flow we can those kind of things. And one thing that I don't think much brokers do is calculating the value add, like you mentioned, because when I hear about value add, for me, it's one number. So it's an NPV, right? Net present value. And if it's positive, then it's good. And if it's negative, it's bad. From what I've seen, because mortgage brokers are not really actuaries, so they show the cash flow or how much more you can borrow and those kind of things. So once you have that idea, then you can easily calculate the net present value, with the discount rate and see, is it, I don't know, 100K, 200K of value. And then you can add it to other components. And governance, it's funny because in the private equity market and then real estate market, there's a lack of so trying to get data out of this is going to be difficult as well. But myself, I'm an actuary, and my partner in our firm is a CFA. So we were trained to build things or build system or procedures with integrity, because that's part of our title, part of our what we've learned. And therefore, it's part of governance too. We study, as an actuary, we study and we always read books about governance and how to create those kind of structures and make sure those kind of risks are minimized as well. So we do work with, for example, external accounting and a legal firm to verify our statements and everything. All our investors receive a digital copy of the titles of each property that we buy. I don't know if others do it as well. I'm sure some does, but I'm pretty sure a lot don't. The problem is not there's no big data of private equity. So even myself, I don't know, I know a few other private equity funds, but they do, but there are many more. And what do they do? I have to become an investor to actually know. And while I believe there's added value just being transparent to our investors, this is what generates word of mouth. And all our investors is current investors who recommend their friends and their professional network to invest with us as well. So how much is that word of mouth value add? For us, it is a big value. But to calculate it, we can only calculate it with an A/B testing, right? kind of. But data is not sufficient to do an A/B test. And I don't know if it's part of governance, but with our profile, we know, and we do stress tests. So kind of like sensitivity analysis. We look at value at risk. These are all terms that I doubt other private equity firm would do unless they have professionals in those kind of fields. But we do look at tail risk. For example, me and my partners who buy life insurance, and we buy life insurance to cover the business. If one of us die, there's sufficient fund to hire external managers to maintain the buildings. Or even if, let's say, I pass away and the shares that I hold, the voting shares that I hold, will be passed to my kids. And my kids might not be apt to run the business. So that life insurance can help the other partners to buy off the shares of my kids. So these are things that, from my understanding, rarely people think about. The people risk part of it, the partner risk. But we it's a everyday thing that we do because it was our career. So these things makes a company, like you say, more resilient, because we look at tail risk that a lot of companies don't look at.